A wild week wrapping up here. Joining us now to discuss is Paul Hickey. He's the co-founder at Bespoke Investment Group and Bespoke Market Intelligence. So, Paul, when you look at this market right now, we've got the Dow coming back just a little bit. You guys had a note out earlier today looking at average drawdowns, how deep they are, and that this one is really kind of run-of-the-mill when you look at the median decline in the S&P from high to lows during a pullback. But does the speed of this decline kind of say something different to you about the current environment?
Yeah, so I mean, that's a great point. So this pullback that we've seen over the last several days here has been the fastest pullback that we've ever seen from an all-time high, fastest pullback of 10%. And what's even more interesting is the fact that the second fastest was 2 years ago in 2018. So I think it brings up a whole broader discussion of how the market structure has changed, and the rise of passive investing has created more of an all-or-nothing type phenomenon. But the look at this pullback we've seen, on the one hand, it's been very sharp and severe, which it's been a violent pullback. But from a broader picture, we hear a lot of people saying that the market's pricing in a doomsday scenario. Well, if the market had already priced in a doomsday scenario, I could get on and say, hey, we should be buying everything because it doesn't get any worse than doomsday. But, we're looking at an environment now where it's about a median decline. So that's the big question that investors have to ask themselves is whether they think this whole virus outbreak is going to be something really bad like a Spanish flu type thing, or if it's going to be a short-term hiccup that's going to last 1 or 2 quarters. If it's going to last 1 or 2 quarters, if that's your view, I think right now you can feel comfortable in equities. Over the longer term, nothing's comfortable about the market right now. But if you're of the view that this is going to be a long, drawn-out period, then there would be further to fall. Nobody knows obviously how this is going to pan out at this point. There's just so much uncertainty out there. But I would err on the side, I would be biased that it's going to be more of a 1 to 2 quarter thing than a long drawn out thing, but that's just the optimist in me.
Sure. I mean, even a 1 to 2 quarter thing could actually, lead to a recession here in the United States. If we're just looking at the Dow, which has basically cut its losses in half from the lows of the session, but I think a lot of eyes still are on what's happening in Treasuries right now. And the 10-year this week, 42 basis points on the yield. How do you factor what's happening in there? What are you watching and finding is instructive in terms of its impact on equities or for the outlook?
Yeah, so this move that we've seen in Treasury markets this week is like nothing any of us really have ever seen. And it caps off what we've seen over the last year, which is a gain in Treasuries of long-term Treasuries have gained 37% year over year. That's something we've never seen. So it's really an off-the-charts type of move. And so now looking back, if you look at periods where, say, Treasuries moved 25% over the course of a year, there's a few more occurrences of that. And when we look at those periods to see what happened, going forward, Treasuries tended to underperform just on an absolute basis, seeing negative returns on a median basis over the next 1, 3, 6, and 12 months, but also underperforming equities in all but one of the occurrences, which was the most recent occurrence that started in September of earlier this year, if I remember correctly. 1 year later, equities were outperforming Treasuries by 14 percentage points, and so that most recent occurrence, where the year-over-year change topped 25%. We still have 6 months left in that 1 year window. So, that story hasn't been fully written yet.
Paul, just kind of looking at the situation right now, this is volatility, a sell-off that's been driven by a large-scale health concern. It's not because of a monetary policy miscalculation or a credit crisis or anything like that. So how does that just causality really change the way that investors should be thinking about their positioning and how much of an impact current and future stimulus might actually have on the market?
Yeah, so I mean, the first aspect is health issue, health scare type issue is, that's a tough one for investors because especially now, because there's so much uncertainty out there. The only thing that cures that uncertainty is facts, and we don't really have a lot of facts at this stage, and it remains to be seen how things are going to go moving forward. What we do know is that the headlines are going to get worse before they get better. I mean, we only have relatively a handful of cases in the U.S. at this point, and when we ramp up testing, we're going to get more cases. So the headlines are going to start to look a lot worse. We're going to see schools start to close. We're going to see more travel disruptions. We're going to see a lot of that. The question is, can the market look past that from what we have now? And one of the things we hear in our conversations the last few weeks is that this time's different. There's really no way to get out of this. You can't just give stimulus. You can't just cut rates. It's a very logical argument because it is a health scare. You're not going to pay people to do this kind of thing, right, just to go out and do things that they would not normally do. But the fact is, when you have sharp pullbacks in the market like this, after the pullback, you never have people saying, okay, we're going to go higher now because of this. I mean, if there was so much certainty that things were going to get better after the pullback, right, then there wouldn't have been the pullback in the first place.
All right, Paul Hickey with Bespoke Investment Group. Appreciate the time. I will talk to you soon.
Thanks. Take care.